We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me again today is Gareth Soloway, President and CFO and Chief Market Strategist of InTheMoneyStocks.com. How are you today, Gareth?
I'm doing very well, Tom. How are you?
Excellent. Great to have you back and have a chat about the markets. You're a pretty high profile trader, so this is interesting to kind of get things from your perspective here. So one of your recent tweets, and you were saying that we're going to see a lot more stagflation, and you're saying that it's lower growth combined with higher inflation. So why is that?
So basically, it's the boogeyman of for economists, anyways, is the term stagflation. And basically what it means is that you see inflation, but usually when you get inflation, it comes during periods of really good growth in the economy. So people are making more money, there are more jobs available. And so if you get inflation during those periods, it's not such a concern because people are making more. So even though prices are going up, people make enough to pay for those prices and even still save some. Stagflation means you don't get the growth in the economy, or you could even see a shrinking economy while you have inflation. And that's the scariest thing because prices are going up and people are not making more money, or they're losing money because they're losing jobs. And that again is the worst case scenario. So you're starting to see kind of the beginnings of that as a possibility. And my thought is that after we get through this reopening, which has been robust economic growth like you can't believe, there's always going to be a letdown period, right? It's kind of like your kid has too much sugar and they go crazy, and then you have that crash scenario where they crash afterwards. So that's my fear, and I think you'll start to hear economists starting to talk about stagflation. It's very good for gold. It's not so good for the economy and for stocks and for individuals.
So something that I've talked about recently with a couple guests on the show was that they see a deflationary environment coming. So why do you see that as not being a real possibility here?
Well, the problem I have with the deflationary thesis is that the Fed is not stopping their printing, right? I mean, they're the dominant buyer of bonds at this point, 120 billion a month. They've been doing it since 2009, and they're not going to stop, especially, I mean, if you don't see inflation, if you see inflation coming back in, they're going to ramp up that buying pressure and printing even more. The government's not going to feel like they can step back from stimulus. They're going to spend more. They're going to run up debt. So inevitably, there's this force working against the deflationary pressure. And we saw this over the last really 5 or even 10 years where the Fed has said, hey, listen, we don't want deflation. So let's just do more QE. Let's print more money. Let's lower interest rates. And they're trying to create inflation. So I think it's kind of silly for people to make that case when the Fed is telling you, hey, listen, we'll print zillions of dollars if we have to make sure that this doesn't happen.
So how do interest rates play into that? We saw at the last FOMC meeting that they were thinking about raising rates, but how are they going to be able to kind of combat inflation if it runs past their targets?
That's going to be the biggest and hardest question that they're going to face. I honestly don't know because they're in a corner, right? So they've got us where they're printing lots of money. And they say, all right, we want inflation. We're even okay running a little bit on the hot side. But if it gets to be too much, will it raise interest rates? Well, they can't really raise interest rates that much because number one, it's going to push the economy into a tailspin where you're going to see economic growth decline too much, which is then going to force them to lower and print more money. And then you have the issue of debt where the only way the US is going to be able to combat the insane amount of debt that it's running up in terms of paying our interest payments is by continuing to print money as well. So it's kind of a weird situation where I think they're always playing for the near term. The Fed is supposed to not be political, but I think being human beings, they're kind of in the position of saying, okay, I don't want to be the Fed president or the Fed chair where the collapse occurs. So I'm just going to make sure that in the short term, we're okay. Let the next person deal with that. I think it's a very short-sighted and bad thing to do, but it's what our government does too. I mean, every politician wants to get reelected again in 4 or 6 years. So that's what they do. They do what's good for the near term. They don't do what's good for the long term of the economy.
Yeah, it really seems like the incentives are misaligned here. And I wanted to get your thoughts on these longer term consequences for this monetary path that the Fed is on at the moment. It really seems like, exactly as you said, they don't really consider tomorrow. So what happens when all this money printing really starts to devalue the dollar?
Yeah, I mean, you have to think that assets like gold really are the beneficiaries. Eventually, I think Bitcoin is a huge beneficiary. I love the long term. And when I say long term, 5, 10 years out prospects for Bitcoin. Short term, I still think it needs another flush down to near 20,000 or even below. That'll probably occur when you get a big deleveraging in the system. One of the things I brought up a lot is how much margin is being used. And margin is basically investors putting up $1 and borrowing $2, or in some cases, putting up $1 and borrowing $10. And that always has a flush out period where panic sets in and then banks start to reel that margin back in. And that'll just create a general large sell-off across the board. But I mean, eventually you're in a situation where the economy is going to shrink back, pull back, and you're going to see things like gold outperform. I think that's my main asset right now that I'm the most in favor of. There's a few stocks along the way as well. Silver as well, I think you can look into as well.
So how do numbers like the non-farm payrolls or they call it the jobs report affect the markets on a shorter time scale here? And is it important to kind of keep in mind when they release those numbers?
Yeah, it is. And I've mentioned this before. It's such an important point. So we saw the non-farm payrolls on this past Friday be announced. And then if you go back to previous holidays where the markets are either closed on Friday or closed on Monday, and there's a big non-farm payrolls report, sometimes what they'll do is they say, oh, we're going to put it out the following Friday. And what you notice, and I've tracked this for years now, probably decades at this point, is that when they push those numbers to the next week, they're poor numbers, which they don't want to release before a holiday weekend. Because remember, a holiday weekend is all about shopping and sales and basically stimulating the economy, right? People go out, they travel, they go to eat and all those things. So the fact that they announced that they were going to release that number Friday morning before the holiday weekend, to me, it was a no-brainer that it was going to be a strong number, one that people would feel good about. Probably the markets would rally, as we saw that they did. And that pushes kind of the sentiment going into spending money that weekend to much higher lengths.
So how does that really play into the narrative for the Fed? Can they let's say spin that in any light that they would like to?
Yeah, I mean, I think the spin is always available. We've seen it in politics that everyone's always trying to spin things, right? And the Fed does the same kind of thing where they'll kind of say, okay, well, this number is hot, but we have to look at the unemployment rate, which popped up as well. So it's not as rosy as it looks to be. So therefore, we don't have to worry about raising interest rates as quickly. So there's always ways that they can spin it because they have enough data that they can pull from where they can always point to one thing or another that isn't as strong, right? And the Fed obviously wants to keep interest rates low for as long as possible. I think that's, again, going to be a big mistake in the long run, but they can always point to different little tactics or little different viewpoints that kind of go to their thesis.
So being a trader, Gareth, this implies that you have a shorter time preference. So how do you separate these let's say, lengths of time? And do you look at any of your trades as being more of an investment rather than a trade?
Yeah, I think long-term Bitcoin and gold to me are more investments. They're kind of what I refer to as insurance. So I always talk to other investors and say, hey, listen, there's always a core position. So I swing trade stocks generally, and same thing with Bitcoin. So, if Bitcoin pulls back to a gap fill, I'll buy it for a bounce. If it comes up here, I'll short it. Same thing with stocks and everything like that. But for me, I always hold a position in cryptocurrencies and a position in the metals. And that to me is the insurance of if I wake up tomorrow and the you-know-what has hit the fan and things are just catastrophic, at least I know I can offset certain losses. Even the dollar collapsing will be offset partially by my crypto investments and my gold investments. So I think it's actually very important to kind of have a distinction between that, where you can swing trade and day trade and invest, and then always think about what's protecting you in the case of catastrophic issues. And that, again, would be the gold trade and the Bitcoin, trading.
Excellent. So how do you go about determining what length of time you want to be in a trade for? I know you kind of set some limits on your website. You have, let's say, end of trade dates associated with some of those positions. So how do you go about determining those lengths of time?
So usually that comes off of the chart and also the analysis that you do, outside of the chart. So it could be in Bitcoin's case, the fundamental case, same thing with gold, where, you just see this pattern of printing money. Interest rates are never going up to the prior levels they ever were prior to the previous crisis. And you see the writing on the wall. So as the insurance goes, that's why I hold those positions. And again, to be clear, they're about 5% of my net worth in total. So it's not like a ton of money, but it's basically like having health insurance or life insurance in case of that situation. Now, when it comes to swing trading, I usually analyze the chart. So if a stock is coming down into a gap fill or into a major moving average, you should get that bounce on the daily chart very quickly, right? So, within days to weeks, that should have a significant bounce. And that'll kind of be how I frame that time sentiment. Now, if I'm looking at a bigger time frame, like let's take a monthly chart. If you have a bull flag on the monthly, it's going to play out, or at least the likelihood is, the probabilities that it'll play out are there. But on a monthly chart, it could literally take months. So it's all relative to that time frame you're analyzing when it comes to the charts.
So, Gareth, I've heard you say recently that you're more bullish on gold this year and not necessarily silver. So why is that?
The main issue I have with silver is that in general, silver is partially a store of safety, right? Just like gold. Gold is basically a pure play of safety and running in terms of inflation and panic. But silver also has that industrial component. So people are using it in cars and batteries and in all these different things, which during boom periods is really good for silver. But during kind of, recessionary periods or slowdowns, it can take a little bit away from that kind of movement of the safety trade. So that's why, at least right now, where I'm expecting this kind of last quarter, fourth quarter air pocket where the market's going to kind of say, okay, listen, where's the growth coming now that the reopening trade is over and the economy could slow down? You could just see silver underperform. And I just think there's a little bit more risk there that I can't quite quantify. And therefore, I'm kind of sticking more towards the gold side, which is a very simple trade to me.
So in a way, that's kind of going back to your stagflationary environment as well, right?
Yes, exactly. Just my worries that, and again, I don't necessarily think we'll hear stagflation occurring in the fourth quarter, but I think you'll hear the economists starting to talk about it. And then maybe next year you will see that scenario, which again, you probably see the markets take a pretty big hit on that as well. Silver again, and to be clear, I don't think that the stagflation or the slowing in the economy will necessarily drive silver lower because you still have that safety trade. It just may not perform as well as gold. Long term, I still think, again, if the printing of money is going to continue and you have a horizon of 5 or 10 years, silver is definitely a good place to be.
So what could we see for the gold price by the end of 2021? Could we see the $2,100 level?
That's my target for end of year. And again, targets are always tough, picking time frames for it to get to certain levels. But I think that's kind of where I'm looking, which will be basically back to those highs. I believe it was in 2020 that we saw, or just above those highs. And then I think in 2022 and 2023, you have upside to probably 2,800 to 3,000 on gold. And again, that's really where we're going to find out, is this inflation transitory like the Fed keeps telling us, even though, it's amazing because, they even in their last policy statement, they came out and said, oh, well, it's a little bit hotter than we expected. It's, basically they're admitting they're kind of like, wait a minute, we're surprised by this, which I'm surprised that they're surprised by it. But I think that we're going to know by 2022 if it's transitory or not.
So what factors really go into pushing gold past those highs that we saw last August, Gareth? Is it mostly inflation? Can it be oil, like cost related? What are the issues that are going to help push gold past those all-time highs?
Yeah, so I think all of those that you mentioned are very, very true. So as inflation kind of continues, you're going to see the cost to drill could go up significantly, which makes obviously the amount that's mined less on less price goes up. And then I also just think the printing of money aspect is going to continue to drive it up as well. And the demand, I mean, I'm not the only person. I mean, you're in this same camp, and a lot of people where they're seeing what the Federal Reserve is doing. And by the way, it's not just the Federal Reserve. It's the Japanese central bank. It's the European central bank. I mean, all these countries are just printing, and they're in this new monetary economy thesis, which is you could just print as much money as you want with no repercussions and just pay down all the debt and just stimulate. And again, it blows my mind that I always put it on my perspective, and I always look at it and say, as a human being, if I were to do this for my household, what would happen, right? Now, a government is the biggest entity. They're going to be the one that holds up the longest. But if I just take out 1,000 credit cards, right, and just start spending and I don't pay those back, I mean, eventually creditors are going to come. They're going to shut off those cards, all those things are going to happen. And while the economy, the US is the biggest economy in the world, if we continue on this path, eventually that's going to be the end game, right? And again, China's already starting to get this digital yuan as the reserve currency of the world. So they want us to have this epic collapse. It's the writing's on the wall for me with the dollar for sure.
So longer term dollar headed lower, correct?
Yeah. I mean, you're seeing some strength now in the dollar, but there's in my scenarios, there's no scenario I run that the dollar over the longer term stays up, especially with the digital yuan's emergence and China pushing it as a new reserve currency. Because remember, countries around the world have to hold hundreds of billions, if not trillions in dollars, because it is the reserve currency. So they have to do, economic deals in the reserve currency with other countries. So they have to have a ton of dollars. If you start taking that reserve currency away and replacing it with something else, there's no incentive for someone like China to hold as many dollars as they do. They'll just start dumping them on the open market. And that's really where you could get an epic collapse in the dollar, actually.
Mm-hmm. So, Gareth, what can we point to that can kind of explain this shorter term or this current strength in the dollar right now?
Yeah, I mean, it's a good question because there were so many people bearish on the dollar. I think that's always part of it. Anytime you have too many investors and traders on one side of a trade, in my opinion, this is an inevitable snapback where you get short covering. And I think that's a large part of it. You could see it in other assets, right? Too many people were on Bitcoin and the hype. If you looked at the hype on Bitcoin when it was trading at 60 to 65,000, I mean, everyone, CNBC was covering it nonstop. I mean, all those type of indicators. And then you saw the retrace. So I think that's a big part of it. And then I also think there's other concerns about, do we have, deflation, these little things that are inching into the vocabulary of investors and in the media that are making people say, okay, well, if we're going to have deflation and they think then maybe the place to be is the dollar. I don't think it'll pan out, but it does give you that reason for a little bit of a bounce.
Mm-hmm. So Gareth, I'd like to go to maybe let's start with the gold chart here. We're speaking, of course, on Tuesday, July 6th, and we finally broke that $1,800 level, got back above it here. So what is there any downside left here for gold? What are the risks that you can see?
Yeah, so I think the risks, I mean, there are some risks out there. The risk would be a stronger dollar continuing in the short term. I think that would be a slight negative for gold. Overall, I think if interest rates, we continue to see interest rates kind of just chop around. Now, generally, people say interest rates higher are bad for gold. I think in the short term, that's true. But if interest rates are going up so there's two reasons why interest rates can go up. One is a stronger economy, in which case interest rates naturally will go up. The other is inflation. And I think if you start to see that inflation-driven interest rate moving higher, gold will actually do fine during that period. In terms of the chart here, you can clearly see you're still in this wedge pattern, which is a bullish pattern. So even though you're chopping and you've been all up and down here, even the downside recently with this recent bounce, if you look at the move up in gold, this is still basically hovering in what we would consider a bullish pattern. Now, it hasn't really broken out through this upper trend line, which was just created with this recent push up, but that would be something that I would be watching. Now, when you're in a channel like this or a wedge pattern, you could easily come down and retest the lows or retest the highs and just continue to chop in this for a certain amount of time. What's interesting about wedge patterns is that eventually a downsloping trend line with a flat trend line, you will meet at a future point, whether it's a month from now or 3 months from now, and price will be forced to either break out or break down. Now, because this is a bullish wedge, meaning it's a bullish pattern, you would favor a breakout to the upside, but there's no guarantees, right? I mean, every pattern, every trade I take is based off technicals, but there's always a possibility that that setup fails, right? So usually what I look for is an 80% success rate trade, and if that happens, then I take the trade. Right. So anyways, bottom line is you're definitely seeing a situation where gold is in a bullish longer term pattern. It just hasn't really broken out yet.
And considering that chart, you've said before that the longer the time zone, or the longer the time that you sit in that channel or that wedge, the more energy in a way that's released when you break out to the upside, correct?
Correct. Yeah. So that's always the way charts are looked at. So when you have something that, makes a high pivot and then it retraces for a couple of days and moves up again, you might get short-term momentum, but it's usually not staying momentum, partially because indicators start to get overbought and so forth. But what's doing here on gold is that it's basically building a base essentially where you're getting all these sellers that wanted to sell. They're all getting out. You're getting people to accumulate. Generally, the big money starting to accumulate here. And then when it breaks out, it's a much more powerful breakout. Think about it like this. Like a good analogy would be, if you put just a tiny bit of gasoline in your car, you're going to get it'll start up and it'll go a little ways and then it runs out of gas. This is allowing for you to fill up your tank to, the full extent that it can be filled before you take your next trip, which means you can go 1,000 miles or you can go 500 miles or whatever that is versus, maybe a half gallon in the tank, which would be just a tiny pullback, gets you maybe 10 miles or so. So that's a good way of thinking about it in terms of consolidation.
So are you looking for a particular event that will catalyze that next move up, Gareth? Is there something that, again, like we talked about longer term inflation, the market recognizing that, is that something that could act as a catalyst or maybe another type of black swan, something like that? Or is it just simply technical driven?
No, I think there's usually with technicals, and this is the weird thing with technicals, is that usually you get something that coincides with it, right? So, whenever I look at a chart, I'm like, oh, this is getting to be an interesting chart at this level. It gets to the level we buy. And the next day something comes out like, this company just announced XYZ or a share buyback. And you're like, holy cow, that's amazing. That's the beautiful thing about charts is that it's usually coinciding, a chart pattern. And part of that chart pattern to understand clearly is that when a stock hits a level and finds support, that could also be institutional where they know the news is coming, right? So, I mean, there's the technical side and then there's the institutional side where they're buyers, and that's why the stock finds support at that level because of that. Just one more thing I'll show you on gold, which I'm actually seeing just now, which is why I love the charts, is you see something new every day. But you could make a case that you have an inverse head and shoulder here forming potentially. And just to show that again, so this would be your neckline right here. So here's your shoulder, head, and shoulder. Now, granted, you haven't completed the shoulder yet, but assuming you move back up here, you would have a beautiful inverse head and shoulder, which is a very bullish pattern. And then what you do is you take the lowest point here to this point here, which is about, looks like 180 to 155. So you're talking about $25 move on the SLV. And you would add that to this breakout, and that would basically get you to 205, which would be basically that $2,100 target on spot gold. So again, we have to watch that pattern to see, but it looks promising.
Mm-hmm. So Gareth, when we're talking about these moves in gold, is there something that we can use as a leading indicator for which way the gold market is going to move?
Sometimes you can use GDX. GDX is a good way to view it. When it comes to GDX, I think it's important to recognize that historically that has been a good leading indicator. So if we pop up GDX here, you can see that, GDX, even before gold started bouncing, was forming this little bit of a green candle down here just recently. And then we've seen GDX move up. Now, GDX is having a negative day today, while gold is still slightly positive. Now, it'll be interesting to see, and we can use this analysis again. Does gold have a pullback in the next couple of days? But historically, GDX, the gold miners have actually led the price of gold slightly on a big move basis. So it is important to watch the GDX, and I do follow that just as a very short-term indicator.
Excellent. Is there the same type of proxy in a way for the silver price?
I would assume so. I haven't followed that one as closely on the silver price, but certainly you would assume that the miners overall lead. And it's very counterintuitive, right? You would think that the miners would lag because gold needs to move in that direction first. And I can't really explain exactly why that happens. I don't know if it's smart money knowing that, you know, the miners usually percentage-wise move a lot more than the actual commodity. So they're positioning themselves in that. That would be my best guess of what happens. But again, it is a unique situation where yeah, it's fascinating. And I would assume it holds true on silver as well.
Excellent. Is there any other, let's say, positions that you're looking at within the metals that are really attractive to you right now, Gareth?
I mean, I do think, again, accumulating a few of the miners is not a bad thing. I mean, you could diversify with GDX, which is kind of covering a bunch of the miners. Newmont Mining here is kind of interesting just in the short term. I am a little bit, you know, and one thing I am monitoring on Newmont Mining here is just this trend line here. Again, you might have a head and shoulders, which is a bearish pattern starting to develop. So I just have to be aware of that as an investor. But I do have a position in Newmont Mining. I have some GDX and I have some GLD right now that we're up on a little bit from when I picked it up just, you know, a week or so ago.
Mm-hmm. Excellent. So you were also saying that there's very likely going to be another leg down for Bitcoin. So can we look at that chart and kind of pick your brain about that as well?
Yeah, absolutely. Let's take a look at that now. Now, this again, what's going on in Bitcoin is very normal, right? So you had this big drop once that previous head and shoulder pattern broke. So here was your shoulder, head, shoulder. You broke right here. You had the big flush all the way down to 30,000. And now you've gone into this, what we would refer to as a quiet period of consolidation, where you have some investors saying, oh, you know, I don't want to buy Bitcoin because it's too scary right now. You have others that are saying, I want to sell it because I think it's going lower. And then others that are saying, I do want to buy it because I think it's bottomed. And all of these individuals are creating a scenario where price isn't really moving, right? I mean, you've basically been stuck now in the lower channel here. Now, the negative of that is that it's creating a bear flag pattern. So bear flags occur when you have a big drop to the downside and you consolidate sideways in the lower 50% generally of that move. And again, if you take this high here, which is really where it started, all the way to this low, you can see this is for sure in the lower 50% of that entire move. Now, most investors aren't aware, but for the bear flag to actually trigger, you would need a daily close at minimum below this trend line of 30,000. Then you would likely get another flush down. I think it could go as low as this 18-ish thousand level down here. But Bitcoin is basically doing exactly what it should be doing. I want to be clear that before that breakdown, it could easily go up. It could even go up to me as high as 48 to 50,000, which is quite a bit higher. But ultimately, anything inside of this move down or from this top would to me be bearish until the high of 65,000 is taken out. Once you take out the 65,000, it's free range straight to 100,000. But as long as we're below that, you have to go on the side of the deleveraging event that has to still occur. And that again could take us easily down to that, 18,000-ish level.
So yesterday was a holiday for the US markets, right? How do you use volume to instruct your moves for the day, or let's say your whatever time preference you would like?
So volumes come in a couple different ways. For me on an intraday basis, so when I'm day trading, volumes are important because they get very, very light around lunch. So for instance, going into lunch today, we basically were looking to buy the S&P, which was down significantly during that period, because you'll usually get a float up. And the thing is, keep in mind that you have the institutions, right? They're trading in the early period of the day when the volume's present. They're going to say, okay, listen, volume's too light. We can't unload 100,000 shares or 1 million shares. So there's no point in us really doing anything. They like to go to lunch. They have a big steak. They relax a little bit. So during that period, it's basically where the small investors take over. Now, the small investor inherently, right? If you ask a bunch of investors out there, just average people, and you say, what's shorting? They're going to say, well, I don't really know what that is. That sounds kind of crazy. Or, oh, that's the boogeyman, right? But so what that tells you is that investors as a whole are going to be buyers of the market, which then creates a natural low volume float if you have that low volume in the market. So it's not unusual to see the markets float up like we've seen recently. Like if you look at the S&P recently, we're barely higher than we were a month ago. In fact, I'll show the chart here. All right, let's go to that. So, I mean, if you look at where we were right over here, we're, over the last month, we've barely gone up, maybe a couple percentage points overall from where we were in April and May. But that was on extremely light volume. So what you have here is a market that I don't trust because it's showing us institutional money is not playing ball. They're not buyers. All this is small investors buying the market, putting more money in their 401k every month, putting more money in the market because they think the Fed is always going to be there. If you ever see a market up on heavy volume, that means institutions are involved. I don't like markets that go up because the small investor who is not really aware of what's going on in the markets, in the charts, the fundamentals, if they're just buying because they think that it's a good buy, that's not a good enough reason for me to be long. And it makes me very wary of the market, frankly.
So Gareth, can we go back to that chart for a sec? And I want to get your thoughts on seeing that chart break that lower trend line. So what does that signal to you? And does that make you even more worried, or how does that play into how you're viewing this chart?
Yeah. So you're referring to this one break here. And so as you guys can see here, you've had this consistent trend line from the lows of 2020 that basically you've kissed it here. You didn't fully hit it here. You kissed it there, hit it. And then finally you got a daily close below. Now, this is where it gets a little bit more into the in-depth technicals on this, but there's something that's called confirmation. And confirmation occurs the next trading day following a move to the downside like this, where you break a key support, or you could break to the upside, a key resistance. And basically, there's a scenario where institutions know that there's a lot of stops right under this trend line, and they want to flush those out and then basically get a lot of shorts on board and then rip it to the upside. So anytime you break a trend line, you want to look for something called confirmation. And again, when you get confirmation, it shows you that it's not an institutional game. This was a classic institutional game where they closed it below. Everyone, including myself, thought it might be a breakdown. Luckily, I told my members that, hey, listen, let's watch for confirmation. And what did they do the next day? They ripped it right back up and went right back inside of that channel. So it's a little bit of a complex signal, but it is something that is very, very useful to knowing if something's a true breakout or a fake breakout, a true breakdown or a fake breakdown.
So again, just understanding that institutional component to the market is key there, right?
It's such an important thing when it comes to stocks. I mean, even arguably, you could say we had it on Bitcoin, right? Because if you look at the Bitcoin chart, and I'll bring it back up, there was a day, 2 weeks ago, where Bitcoin broke below 30,000. I think it went even as low as almost 28,000. And there were so many people that had stops right under 30,000, right? Just under 30,000, because that was the low pivot. I mean, that's where it makes sense to put a stop. Mm-hmm. And it broke below. Everyone started jumping on the bandwagon of like, this is the move down to 20,000. And what did they do? They reversed it and got it right back up. And they basically just lapped up all those Bitcoins down there on that stop. And then they brought it back up, and they've just been selling those off to those same investors that were fooled and making that spread. So, I mean, just think about people exiting under 30. And now those same people are like, darn, I made a mistake. I'm going to buy it back at 35,000. And the institutions are just like, well, thank you. That's an easy $7,000 gain for us, Mm-hmm. And again, it's just one of those things where if you can put the technicals in your favor, you don't avoid these pitfalls, but at least you know them enough to put them in your favor oftentimes and be careful enough.
Mm-hmm. So was the volume confirming that the institutions were buying below that 30,000 level?
You never know for sure, right? Because Well, that's not true. The fact that it didn't break lower told you, yes, the institutions, right? So you saw a ton of volume in that range. You know, a lot of stops were run, which creates a lot of volume. The fact that you didn't see a further collapse and Bitcoin recovered, that definitely told you that there was institutional interest there. Now, again, for me, it's probably shorter term institutional interest, but nonetheless, it's still buyers, you know, I just don't think they're going to, if they're traders more, they're not looking to hold for the, 65,000 again, or 100,000 or 500,000. I think you will see that happen, but you need to see a better kind of energy efficiency story come out on Bitcoin where there's more energy efficiency. I think getting out of China in terms of China cracking down on Bitcoin and it going towards the US, you will see that happen sooner than later. And then I think you see corporate America start to buy into Bitcoin again.
Interesting. So Gareth, the last time we spoke about corners of the market that you see opportunities for growth, can you share with us what some of these trades are? Are these mostly in, let's say, emerging markets, or where do you see opportunities for growth right now?
Yeah, so I'm a contrarian with a lot of my trading. I buy when things are really nasty. I sell when things are euphoric. For me, it's definitely right now looking at China, which again, most people would be like, "Oh, you're crazy." I picked up Alibaba today for the first time here. Let me bring up that chart. You can see that stock's getting absolutely crushed the last 3 days. If you look at this chart, it's well off of the recent highs. Now, it doesn't mean it can't go lower, but I like situations where everyone's throwing the baby out with the bathwater. And again, I'm not saying that tomorrow it's going to reverse. I'm just saying that at least these valuations on some of these Chinese names make more sense. And there's always a period where investors will freak out over something going on. You have to kind of keep a logical mind. China isn't going to, mess up all their golden children company-wise when it comes to, Alibaba and Baidu and all these other names. They're trying to reassert themselves. I think they feel that a lot of these companies in China got away from doing the proper things that as a government, the Chinese government wanted them to do. And so they have to flex their muscles. It's kind of like, again, I always refer to, now that I have kids and such, it's like my almost 4-year-old, she gets away with this, she gets away with a little bit more, and I kind of let it slide. And then finally I'm like, all right, listen, this is getting out of control and I have to put my foot down. Right. And then it kind of brings her back in, and then she'll start to kind of push the line a little bit more. And I think that's what China's doing, which is in, their right to do, obviously, but it gives us an opportunity as investors to get things that are much less expensive in a very expensive market, frankly. I mean, if you look at the PE ratio of Alibaba to a lot of these other US stocks, I mean, it is night and day what the PE ratio is.
Mm-hmm. So Gareth, I'd like to go back to that chart for a sec, if you don't mind. Is there a trend line or a support level, let's say, that you can draw across the bottom, let's say right half of that chart to kind of see that as a level that you can see not necessarily breaking below?
Yeah, so there is, although it's very close. So basically you already broke it here and then bounced, and then you retraced here and bounced. But you can see that there was this pivot here, which is kind of the closest pivot to pivot. And then you got below it here, never confirmed, got back above, and now you're back below it. So Alibaba definitely is into support. What I'm seeing here on the chart, and I'm doing this analysis live, I haven't looked at this chart in terms of this. One thing I'm also watching is there's a short-term trend line right here, which you actually hit today. So you can see pivot low to these pivot lows, and then the low of the day is right there, which gives you a good basis of support. Now, again, support can be broken. It's just giving you basically an odds, a probability that it holds. But if it does break through there, let's zoom out on this chart and just see what we have here. So this would actually be a very important trend line for me. So look at that. So the longer the trend line, the further back it goes, the more powerful it becomes. Not only if it holds, it should be a huge bounce, but also if it breaks, then it's a big break. But you can see this long-term trend line, kind of like the one on the spiders, right? Where you had this one going all the way back. This one just goes back to 2015, so it's much, much further. But you could see if you dip down here, I would definitely be looking to add to my position on Alibaba as well.
Excellent, Gareth. There's a lot of info and a lot of good tips there that we went through. Is there anything else you'd like to touch on before we wrap up here?
No, I think that really covers it. I think overall the interest rates are the most important thing that we have to follow as investors. I think that goes for gold as well. In the short term, obviously inflation numbers are influencing yields. So all of that kind of combined is what's going to drive the market over the next probably 6 to 12 months, including whether or not it's transitory, the inflation, or whether or not it sticks around. And again, don't be fooled when the Fed claims victory. When you have, let's say we have 6% inflation or 7% inflation right now. When inflation comes back to 4%, the Fed's going to say, okay, see, it's transitory, it's coming back down. What you want to do as an investor is say, okay, that's pulling back because obviously with lumber up 300%, it wasn't going to hold up there. But what do we see long term? Is it going to be above 2%? Is it 3%? Is it 4%? Where do we settle in for the next year to 2 years? And that's going to be the kicker for everything.
Perfect. Of course, you're available on Twitter at Gareth Soloway and at ITMS and InTheMoneyStocks.com. Gareth, thanks so much for your time today.
Thank you, Tom. It was a pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.